Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, this stock market has not been doing well in the last couple of months. I think since the beginning of the year, and when you look at the last 6 months, it's doing really well. Since November it's gone up quite a bit, but since January things have not been great, and a lot of that is because of so much uncertainty in the markets, in the global situations, things that are happening basically the Middle East, things that are happening in Russia and Ukraine, and things that are happening in general commodity prices. There's so many moving parts, as well as of course the interest rates and so on. So this is a good thing for long-term investors, and what we need to do is look out for opportunities within sectors, within stocks and so on. Especially if you're a stock picker, it's really good idea to start looking at different sectors. So what I've decided now to do is in the next few weeks is just look at different sectors that have not performed well, because when one stock doesn't do well, I get it. It's maybe something to do with they have not reported, or basically earnings report is not great. The sentiment has slightly changed. There's a bit of a decline in their revenue, or there's a problem with the business, or the management are not great. Whatever it is, there's explanation for it. But when the entire sector, and when I say sector, I'm talking about technology, I'm talking about real estate, I'm talking about energy and consumer discretionaries and consumer staples and so on. When the entire sector is not performing well, then we need to look at the bigger picture. We need to look at the macro economy and say, okay, is there a good explanation for this, and how long will this last? So if you remember, about 2 years ago, we were in a situation where semis were not doing well at all. So companies like Qualcomm, Broadcom, Nvidias, and so AMDs, Intel, all of these companies were not attractive at all. And in fact, they were expected to report negative earnings in 2023, 2024, and so on. And all of a sudden, something happened and it quickly changed. And that change was basically the start of the AI boom. But there are so many sectors that have not done well at all in the last few weeks, so last couple of months. So we're going to look at that today. And bear in mind, some sectors are down because of there must be some explanation for it. And genuinely, I will always say to you guys, just make sure that you have the bigger picture, and just don't sell stocks or buy stocks just because someone said it. So there are always reasons why these sectors, like I said, the semis were absolutely not doing well, because there was no expectations, there was no new initiatives or new technologies, new innovation or anything like that at that time. And as soon as basically AI started, Nvidia came up with this basically amazing idea of AI existed, but how they can actually generative AI and how it can be used. And then OpenAI came out with ChatGPT. I think that's where it all started from. Things have changed this slightly. So since then, we've seen stocks basically like Nvidia and so on. Things like companies like Broadcom, for example, which is my biggest holdings, has actually gone up. This company, when I was buying this company, was $483 per share, or £369 per share. And since then, what's happened is now we're looking at $1,344 per share right now as we speak. So it's absolutely crazy what's happened in the last, basically, you can see here in the last couple of years, but last couple of months. But you see here that it's actually now my top holdings keeps changing between Qualcomm, Broadcom, and S&P Global. So the moral of the story is just there are opportunities out there. You just need to look for it and just understand the bigger picture, inshallah. So basically, I'm going to talk about today a sector, and I'm going to talk about 5 companies within that sector that are undervalued at the moment. But before we do that, as always, if you can join us at the Patreon account, that would be absolutely amazing, where you can see all the buys and sells that I make. You can join the Discord, where a lot of brothers are sharing very good practices, talking about things that they're doing, buying, selling, why they're buying certain things, why they selling certain things, and so on. So the sector we're going to talk about today is real estate, and I've got 5 undervalued companies within that sector that seem very attractive right now, and I will share the details with you guys. But as you can see here, this is the S&P 5. Basically, this is S&P 500. This is the Vanguard Real Estate Index fund, and when you compare the two, basically for the last 6 months, you can see the real estate one is actually doing well. 12.5% against 23%. So not bad at all. However, when you look at the last basically year to date, so since the beginning of January, you could see it's down 10%. And a lot of that is because of the interest rates. Its interest rate in the UK, in the US, for example, was flat in 2020. 2020, basically, you can go to the bank and walk away with hundreds of thousands of pounds for no extra price, basically, without having to pay any more interest. And for that reason, a lot of people took that opportunity, and of course bought properties and cars and all sorts of things. And these companies do tend to do well when actually interest rates are almost zero. And there's two reasons for that. One, they can actually go to the bank and get a loan, buy new land and build those properties and so on, as well as, of course, the properties that they build will be now attractive to investors or people that want to buy because the bank is actually offering them money. So they benefit a lot where interest rates are very low. Since then, things have changed slightly. We're now looking at over 5% interest rate in comparison, of course, is zero. And top of that, when you go to the bank, they need their cut. So they'll ask you for another 2% on top of that. So you're looking for 7% interest rates for a mortgage and things like that. So for that reason, the companies have gone down quite a bit. So what I'm going to do is I'm going to share with you very quickly 5 companies that could potentially be a good investment. Again, as always, please do your research. And again, as always, we're human. We don't agree certain things. And if you don't agree what I'm talking about here, that's absolutely fine. That's your opinion. That's your thing. Then just do your own research and do what you need to do. Okay. You don't need to basically go in the comment section and start talking about this and that. Of course, yeah, you're entitled to your opinion. Do what you need to do. Just switch the thing off and just go and do your thing, inshallah. So let's talk about this. So we're going to talk about the sector. We're going to talk about market cap. We're going to talk about the prices, price to free cash, funds from operation, the dividend yield. So this is equivalent of PE basically. We know the dividend yield, payout ratio, the 5-year dividend growth rate, how long they have been increasing that dividend, how much you will get, the safety, growth estimate next year based on Yahoo Finance, analysts that are from different banks and companies and so on, the average we're looking for here, and then the 5-year, and then a Morningstar valuation and target price. Again, if you don't agree with Morningstar valuation, that's absolutely fine. Find another company that works for you. For me, I like the fact that I feel like they give you extra kind of margin of safety when they actually predict certain things or valuations. The models that they use has actually been realistic enough for me, in my opinion. And then, of course, the target price. Now, the first company we're going to look at today is Public Storage. This is self-storage REIT for 45 billion market cap. It has basic current price is 257. Price to FFO of 17 right now. Dividend yield of 4.66. I believe this is one of the highest it's been, I think, in a while. Let me just double check. There we go. The 5-year average is only 3.44. Right now we're looking at 4.66. So this is actually quite nice to see. But based on that, it seems it basically undervalued at the moment. And looking at the payout ratio right now is about 83. Remember, REITs, you can go up to 90%. Sometimes. Okay, 5-year growth rate of 8%, which is nice. Dividend streak just 1 year. Annual payout $12. Dividend safe to 96%, so very, very safe. Growth estimate next year 5%, decline of 20% after that. Morningstar valuation is saying about 60% discounted. $310 per share is where they think the price should be. Now looking at the basically expectations moving forward, the estimates, if you like, we're looking at FFO estimates, okay, of almost a flat this year, then 4%, then almost 4%, then 5%, and so on. In terms of revenue side of it, we're looking at about 5% every single year in the coming years. So nothing huge, nothing to worry about either. Prologis is the next one that we're looking at today. This is industrial REIT, 96 billion market cap. Price right now $104 per share, and price to FFO of 23, which seems a little bit expensive, and I'll check that in a second. But I've not seen this company actually trade anything lower than that for quite some time. So it'll be interesting to see. So it seems undervalued. There you go. 2.5% is the dividend yield. The 5-year average right now is 3.69. So yes, for that reason, actually seems undervalued as well. 69% in terms of payout ratio. 5-year growth rate of 13%. 10 years of increase in that dividend. $3.84 is what you will get in terms of per share that you own. Dividend safety of 61%, so that's safe. Growth estimate next year is 17%, then 6% decline after that. 13% discounted right now. $120 per share is where they think the price should be. Just to show you the expectation moving forward, or the estimates, just 3% decline this year. Then after that, basically 12%, 18%, 14%. Remember what we've just seen on website Yahoo Finance, they just give us the average of all of this for the next 5 years. But right now, basically decline of 3%, then bounce back about 13%, 11%, and then it's almost 12%, which is quite nice to see. And in terms, next company that we're looking at today is Mid-America Apartment Communities, and that's multifamily residential REIT, 15 billion market cap, $129 per share right now. Price to FFO of 16, dividend yield 4.55%, which is nice. 68% payout ratio, 5-year growth rate of 9%, dividend streak of 13 years, annual payout $5.88. Dividend safety of 97%. Growth estimate next year 1%, then decline of -4%. Morningstar basically saying it's about 50% discounted right now. $150 per share is where they think the price should be. And as you can see, it's 120. Let's call it 130 right now. And looking at the price to... So looking at this, as you can see here, there we go. Where am I going? There you go. So in terms of dividends, it's basically right now we have 4.5%. But look at this, the 5-year average is only 3, basically 3, let's just call it 3.2%. So it's actually seems very cheap, and it seems undervalued at the moment. Looking at Morningstar valuation, Seeking Alpha estimates, so -5%, 2%, 5%, or 6% almost. And then in terms of revenue, more or less basically flat this year or next year, about 2% I will say, then about 3%, then about 6%, then 7%. When it comes to this one, I've seen it over the last whatever years has always been overvalued. There is a data center REIT, so basically they own a lot of those data centers. 69 billion market cap, $731 per share is where the price is at right now. When it comes to price to FFOs of 20 right now, so if we look at again to where it's been in the last 5 years, you can see 1.74, and right now we're looking at about 233, which is basically seems cheap and basically based on that. Payout ratio 47%, which is quite nice. The 5-year growth rate of 10%, and they've increased that dividend for 8 years in a row. $17 is what you will get for every share of this company that you own. 86% in terms of dividend safety. Growth estimate next year 13%, then 16%. A lot of that's because of the data centers and the boom with everything else, with Nvidia building all these data centers and so on, and the supermicros or whatever technologies and so on. So for that reason, it's actually got good basically outlook in the next 4 to 5 years. Fairly valued right now, $700 per share is where they think the price should be. And looking at the valuation, basically looking at the earnings estimate for the next few years, 11% basically this year, almost 10% next year, and then 8%, 9% following year, 12% after that. And then in terms of revenue side of it, 8%, 8%, almost basically 9%, 10%. So just quite decent as well to see that. Finally, the last one is Equity Lifestyle Properties. This is a single family residential REIT and 11 billion market cap. Price right now is $60 per share. Price to FFO of 72%. Growth estimate, dividend yield of 3%, just over 3%. Adjusted FFO payout ratio of 23%, which just seems quite low. Let me just double check that. I think these two were swapped to the formulas. So the price to FFO is only 23 and the payout ratio was 72%. The 5-year growth rate is 10% and dividend streak of 19 years of paying and basically increasing that dividend. Payout ratio, the annual payout is $1.91. Dividend safety 86%. Growth estimate next year 6%. Then it's 6% and 8% after that, and then 19% discounted right now. $77 per share is where the price is at right now. Where they think the price should be right now is about $60 per share. And looking the estimates for the next year in terms of earnings, 5%, 6%, almost a basic 7% there, 6%, and then another 6%. When it comes to the basically revenue side of it, about 4-5% there, about 3%, so decent, and 8% after that. So if you just focus on the first 3 or 4, then you can see it's actually doing okay. Now in terms of the one of the things that we wanted to look at is this right here. So the 5-year average dividend. Okay, so basically 2.2% is basically where it's been in the last 5 years. The average for the last 5 years right now is about 316, which kind of shows us it is a little bit undervalued at the moment. So that's the 5 REITs that I wanted to talk about today. Again, that was very brief. So if you're interested, learn more about the companies, just go to their website and learn more about them. And in terms of Sharia compliance side of things, you can see here, you can pause the video and have a look at. And MMA is basically the only one that has a higher interest bearing debt. So just to be honest and transparent, I do own 3 of these REITs. Okay, so so if you want to know which ones are the 3, so I definitely own this one, and I think it's in this portfolio, so I can share that with you here. So yeah, so this is public storage, and as you can see here, I'm down about 11%. $284 per share is basically my average, or £231 if you like. I do own a couple of more. If you want to know basically the other portfolio interactive brokers portfolio, then go and basically join us on the Patreon account, where you will get access to that, inshallah. Have a wonderful day. Assalamu Alaikum.